With me now to take a closer look at this is Douglas Holtz-Eakin. He is president of the American Action Forum, as well as a former director of the Congressional Budget Office and former chief economist for the Council of Economic Advisors. Douglas, thank you for being with me. The president says it will make a difference over time. Now, according to the Energy Information Administration, the U.S. consumed just under 3 billion barrels of oil last year, or an average of about just over 8 million barrels a day. Just how much impact will this move actually have on gas prices?
I'm not optimistic it'll have any substantial impact, to be honest. It's a small release. It has been well signaled. The administration's talked about this for several weeks, so markets were anticipating it. Whatever benefit it would provide has already happened in pricing wholesale gasoline. So this is not a panacea. Many administrations have done this in the past. It's typically not been very successful, and I wouldn't expect a big move out of this either.
Would this have to be done over and over again in order to have any real effect? I mean, the Strategic Petroleum Reserve is only just about 600 million barrels of oil, right?
You know, the Strategic Petroleum Reserve is, you know, a couple of weeks worth of genuine backstop for the United States. But it's not a solution to a fundamental mismatch between global production and global demand for oil. And that's what's driving this. You can't fix it even with a coordinated release across these countries. And so this is an attempt. I think it's every administration that faces one of these situations likes to go to the SPR and look at the behavior of oil companies. Those are standard pieces of the playbook. But in the end, it's going to take real realignment, real changes in the demand for oil, and real production increases outside the United States.
So why is this happening, though? Why is it happening now?
This is just the fallout from the pandemic. I mean, if you think back to April of 2020, we briefly saw oil futures prices go negative, right? There was simply no demand for oil because there was no commercial air travel, there was not much travel at all, and we really just, as a result, saw a lot of production cuts back. There was no demand, there wasn't a lot of supply. With the arrival of the spring of 2021, widespread vaccinations, opening up of the economy, a rapid increase in demand that was not matched by increases in supply. That's the fundamental problem. It'll get fixed over time, but it won't get fixed by this small release from the SPR, and it won't get fixed quickly.
Was there then a glut of oil, and now there is a dear shortage of it?
Yeah, we've hit both extremes in the course of the past 18 months, no question about it. But I think the real issue is the one that you alluded to. It's not just gasoline. Energy as a whole is only 7% of the typical family's budget. If you look at food prices, they're up sharply. If you look at core quote prices outside of food and energy, they're up at a 5.5% annual rate so far this year. So there's a broad inflation problem, and that's the issue for the American family. Right? They're being hit by this. Wages are rising, and that's good news, but they're not rising as fast as these prices are, and so they're falling a little bit behind every day.
I mean, the cost of rent, of food, of so many things, and I'm so glad you kind of bring up it's more than just one industry or one issue. Meanwhile, the Labor Department reported this morning that only 199,000 people filed first-time unemployment claims last week. That's the lowest number since November of 1969. What does this tell us about the state of the job market right now?
Well, we know that the labor market's red hot. I mean, we have seen demand for labor, you know, openings that outstrip the number of unemployed workers, increases in the combination of workers, hours, and average hourly earnings that have been about 7.5% in an annual rate. That's a lot of demand for labor. So a low number is unsurprising. You know, I take every weekly number with a grain of salt. There's a lot of noise in these and difficult seasonal adjustments, but this is just a reminder that the labor market is very tight, and that fundamentally we will get rid of some of these shortfalls when we see people resume participating in the labor market. We're about 2.5 million female labor force participants, below where we were in February of 2020. We've got shortfalls in prime-age men as well. Those are slightly mysterious to everyone who looks at this problem. Why aren't people coming back? But until they do, tight labor markets mean, you know, supply constraints in services and supply constraints in goods. And you hear it with the truck drivers not coming to the food bank. This is a story repeated across the economy.
Yeah, I mean, yeah. And although the unemployment numbers are extraordinary, I mean, we have to remember the unemployment rate among African Americans and Latino is higher than the average one. So there's a lot of work still to do. Douglas Holtz-Eakin, thank you so much for being with me this morning.